Welcome to this Killick Explains Finance video. This week we're going to take a look at 3 things investors should not do in volatile markets. Now, you don't need me to tell you that markets are about as volatile as I've ever seen them over recent weeks, but what are the things we're going to try and avoid doing whilst markets are playing out in this kind of whipsaw manner? Okay, so the background is what? Well, stock market volatility is at all-time highs or pretty close to it. One way of measuring that is the Chicago Board Options Exchange VIX, CBO VIX, a volatility measure based on options, and that has spiked as high as I've seen it in recent times. Some investors will be sitting on large unrealized losses, which feels unnerving. So as you watch share prices come down, if you haven't cashed out, a lot of people choose not to, you'll be sitting there thinking, gosh, only 2 weeks, 3 weeks, a month ago, I was so much better off. But they are, I should stress, unrealized unless you sell shares, which we don't do, either as a result of panic or forced selling, as I call it. So here are 3 things you shouldn't be doing in the current market, all right? So things to think about. Now, easy for me to say, a big drop like we've seen recently is a shock, but nonetheless, important to stay level-headed and stick to a long-term investing strategy. So, number 1 is give up on equities. Certainly at the point where the market's already corrected a couple of thousand points, let's say. So basically, the biggest crash that I was just about around to witness is the early 1970s, where the stock market lost 2/3 of its value. Just to put it in context, that was the big one, if you like. Some investors almost certainly left the market having watched it drop and possibly never went back. And that is a pity. Context is everything, because within a few years the market had actually recovered, and as we know, benefit of hindsight is a wonderful thing, but if you've got faith in human ingenuity and progress and economic growth, eventually you're likely to see history repeat itself. And what do I mean by that? Well, that was the bad phase. That was the early 1970s, and watching an investment that started at, say, at 25,000, that's the red bar if you like, as comparison in 1971, be reduced to 1/3 of that just a few years later. Anyone sitting there thinking, oh crikey, I should have cashed in, and they might have thought, oh, I should cash in there. You know, and obviously if you were lucky enough to go to cash there, fortunate enough, market timing if you like, then you'd have been thinking, well, great, well, I got that right, but probably not crediting enough of that to luck, as you should. Anyone who stayed invested might have been thinking, right, I'll pull my money out and I won't go back. But that would have been a mistake because, and these are sandwiched in at the beginning, the way this is presented doesn't give you the full scale of the problem, if you like. There's the bit we were just looking at, compacted, if you like, and there is the subsequent market. Now, I've only taken this out, 2018. If I continued it, the volatility obviously starts to spike pretty dramatically. But, you know, we've seen it before. There's a big burst of volatility. There's another one. That doesn't look like it, but that was a monster. And the point is the market has typically gone on to bigger and better things eventually. Trying to time the market. I mentioned this just now. That's mistake number 2. So giving up completely on equities would be number 1. Trying to time the market would be number 2. Now, basically, anyone who wants to call the bottom is usually relying on luck more than judgment. There are some judgment calls you can make about the state the market's in, but basically you're pinning a tail on a donkey to think you're going to get it right. And if you get it wrong and miss big bounces, now you must have noticed that usually straight after the biggest dips you get some colossal bounces as well, some of them based on a change in sentiment, some of them based on shorts covering their positions, I cover this in other videos, and some of them maybe based on a change in the underlying data. But whatever the cause, if you miss them, as JP Morgan's long-term studies have shown, you can easily halve or worse your long-term returns from equities. So a better bet is to be patient. In the current climate, people won't want to necessarily go all in, if you want to see it that way. They don't want to say, well, I've been out of the market for a while, let's pile back in again. But a strategy where you drip money in will probably, can't guarantee it, work out in the long term. You'll buy on some of the dips, as it were. Just to illustrate the point about pound cost averaging, which is what I'm describing, that's the technical term for it there, here are some made up unit prices encompassing a dip. So imagine you're buying units, they go from £5 to 4 to 2, and then long term, these are just periods over here, they go back up again. So a sort of U-shaped dip, if you like. If you put a lump sum to work of £1,000, you'll buy 200 units at the start. All right, and if prices recover, U-shape if you like, you'll be 200 units to the good at the end. But a pound cost averager would say, actually, I'm not sure about committing £1,000 in period one. I'm going to do 4 dollops of 250 and see where I get to. And because, essentially, what this is trying to show is because by pound cost averaging, you're actually buying when units are a little bit cheaper at times, you end up with more units, is the bottom line. Now, pound cost averaging is a good strategy, therefore, when markets are volatile. Number 3, don't be too clever. So don't give up equities, don't become a market timer, especially if you haven't been one before, which hopefully you haven't, and don't be too clever. Now, what do I mean by that exactly? There are products that try to exploit volatility. So you might find snake oil salesmen coming along and trying to sell you inverse geared ETFs. These are things that rise when the market falls, fall when the market rise, and even derivatives, call, put options, for example, futures, spread betting. There are lots of products out there that claim to make you money as the market falls, and there are people out there who can make money as the market falls. But be very wary about thinking, oh, I'll just hop on that bandwagon. All right, all of these things are dangerous in the wrong hands, a bit like my lawnmower. Now, just to illustrate that with one of these products, okay, would you expect this? So you've got a fund offering twice the inverse performance of the index. You're thinking, well, this is good. So as the market falls, this thing gains. So that sounds pretty handy. And what's more, it gains at twice the speed, if you want to see it that way. And there are products out there, exchange-traded funds, that claim to do exactly that. That's what it says on the tin. But even if you get the market direction right, you may not get what you're expecting at the end. So this table of horrible numbers is trying to show that essentially if the index starts at 1,000, and let's say the ETF starts at 1,000, because it's supposed to follow it, right? And it's one of these things, twice the inverse performance. And the market goes up 10, down 20, up 10. So the market hasn't moved. All right? So the index will track that up 10, down 20, up 10. But because the index is repriced on a daily basis, okay, the percentage doesn't tell you what the index will actually have done. It'll have dropped slightly. And that's just a consequence of the fact that each day you're marking it up or down, whereas the top line of this slide is just looking at the overall effect, if you like. Now, this beast, twice the inverse performance, if you like. So, when the market goes up, this thing goes down. Okay, thanks for that, Tim. So, 800 there. But now look what happens. Market goes down, this thing goes up, but because you're marking the 40% against this number, you get to there. And then because you're marking the subsequent drop, twice the inverse performance of the index, against this number you get to there. Bottom line is, index down a bit, your thing down a lot. Wait a minute, wasn't this supposed to be the inverse performance? And how's that twice the inverse performance? All very confusing. So it doesn't do what it says on the tin, at least not as most people would understand it. Okay, so be careful. Trying to make money in a falling market from clever products, not a good idea. Conclusions, therefore. A long-term approach should not be derailed by short-term volatility. If it is, then something's gone wrong with your long-term plan, I'd suggest. Don't start doing things you normally wouldn't because the market's falling. Don't start reading headlines saying, hedge fund cleans up on short bets, and think, oh, I wonder what this shorting stuff is. I need to get in some of that, because you'll be going into territory which is incredibly dangerous potentially. Don't touch your face or your portfolio. It's one piece of advice I heard recently from a pension fund manager, and it's not bad advice. Trying to time the bottom, abandoning equities at the bottom of a bear phase, even if you can time the bottom of the bear phase, not a good idea. And trying to be too clever to claw back those paper losses, also not a good idea. Usual place for any queries, and to watch other videos, killick.com/learn.